So, if your home has been damaged by a disaster, you've probably heard that you can deduct the loss on your taxes. And that's true. But here's something you probably haven't been told. There's a hidden rule in the tax code that can turn that deduction into zero. It's a trap, and it hits retirees especially hard. Today, we're going to pull back the curtain on that trap and show you the exact key to avoiding it. The tax code is supposed to be there as a safety net when you have disaster losses that insurance doesn't cover. It's a principle most of us know about. But as you're about to see, the real story is buried in the details, and those details can cost you thousands of dollars. So where's the catch? Well, it's buried in a specific calculation on IRS Form 4684. For a lot of retirees who are on a fixed income, this calculation creates a financial hurdle that's so high that even a significant, painful loss doesn't end up qualifying for any deduction at all. It's really a trap, and it's hidden in plain sight. Okay, so this trap, officially, it's called the 10% AGI limitation. For what the IRS calls a standard federally declared disaster, you're only allowed to deduct the part of your loss that is more than 10% of your adjusted gross income. Let's dig into why this is such a roadblock, especially for seniors. Okay, so this number, your adjusted gross income, or AGI, it's everything here. Now, if you're retired, your AGI isn't just a small pension check. It includes your Social Security benefits, any money you pull from traditional IRAs or 401ks, and really importantly, your required minimum distributions, those RMDs. All of that together can create a pretty high AGI on paper, even if your day-to-day cash flow feels tight. All right, so let's walk through how this standard calculation works. It seems simple at first. First, you figure out your total loss that wasn't covered by your insurance. Then, you subtract a flat $100. But it's that third step that's the painful part. You then have to subtract 10% of your AGI from your loss. Whatever's left over, if anything, that's your deduction. Okay, let's put some real numbers to this so you can see what I mean. Let's say your AGI is $80,000. A storm comes through, damages your roof, and the repair costs you $7,000 out of your own pocket. So you take your $7,000 loss, you subtract the first $100. That leaves $6,900. But now you have to subtract 10% of your AGI, and 10% of $80,000 is $8,000. Since your loss is less than that $8,000 floor, your legal deduction is a big, fat zero. Nothing. You get absolutely no tax relief for that $7,000 loss. So you might be thinking, is there any way around this 10% trap? And the answer, thankfully, is yes. The solution is in a really important distinction the IRS makes between different types of disasters. See, not all disasters are treated the same way, and knowing this difference is the key to unlocking the deduction you deserve. On one hand, you have the standard federally declared disaster, and you're just stuck with that punishing 10% AGI floor. But on the other hand, if your disaster gets this special designation, qualified, things change dramatically. That 10% floor is completely waived. It's gone. The small $100 reduction goes up to $500. But here's the best part. You don't even have to itemize your deductions. You can add the loss right on top of your standard deduction. This is a complete game changer. The benefits you get when your disaster is labeled qualified are just huge. It's like a financial shield for homeowners, protecting you from that painful AGI rule. Let's break down exactly what that shield gives you. So, let's recap because this is so important. With a qualified disaster loss, that 10% penalty just vanishes. Your loss is only reduced by $500, not 10% of your entire income. And for so many seniors, this is the biggest benefit of all. You can take the standard deduction, which most retirees do, and you can still add this disaster loss right on top of it. It's a direct and much easier path to getting tax relief. Okay, so the big question is, how do you know if your disaster is qualified? Well, it really comes down to timing. The Federal Disaster Tax Relief Act created this special category, and it applies to major disasters that were declared by the president within a specific window, generally between the beginning of 2020 and early 2025. You'll have to check the official FEMA declaration for your specific event to see if it falls within these crucial dates. All right, let's say you've done the research and your disaster is qualified. That is a huge win. But now comes the next hurdle, which is proving the amount of your loss to the IRS. This part can feel intimidating, but there's a straightforward system the IRS has put in place to help you. And this is where a lot of people get worried. They think, oh no, do I have to hire some expensive appraiser to figure out the fair market value of my house before and after the storm? It sounds like a costly and complicated process that, frankly, nobody wants to deal with. And the good news is, often, no, you don't. The IRS has provided an official approved alternative to going out and getting a formal appraisal. It's called the Safe Harbor system, and it was designed specifically to make proving your loss much, much simpler and less expensive. The IRS has created something called a safe harbor. Think of it as an official, pre-approved shortcut. The most useful part is the contractor method. What this means is you can use a binding, itemized, and signed contract from a licensed contractor as your proof of loss. The price on that contract to fix the damage, that becomes the basis for your deduction. No appraisal needed. It's a simple, powerful, and official tool. Okay, one last tool for your toolbox. And this one is all about cash flow, getting you money when you need it most. It's an IRS rule that basically works like a time machine for your tax refund. Its official name is the Section 165I election. Here's how it works. Imagine a hurricane hits in August of 2025. Now, normally, you'd have to wait all the way until you file your 2025 taxes in April of 2026 to see any refund. But this special election lets you claim the loss on the prior year's tax return. So you could amend your 2024 tax return right away in September and potentially have a refund check in your hands by November of 2025.
So what's the bottom line here? It's simple. This strategy gets that refund money into your bank account months and months earlier, providing you with critical cash to help pay for repairs and start rebuilding when you are most financially vulnerable.
Okay, so let's put this all together into a clear action plan for you. First, go to the FEMA website and look up your specific disaster by its declaration number. Second, check to see if your county was designated for individual assistance. That's a key trigger. And third, see if the incident dates align with that qualified disaster loss window. Just knowing this information gives you powerful options and protects you from that 10% deduction trap. You know, it's easy to feel like the tax code is this big, scary monster, but it's not. It's just a set of rules. It can be complex, yes, but it is logical. And when you understand the specific rules that were designed for disaster recovery, you can make the system work for you and make sure you get the relief that you're entitled to. Now, of course, this is all for your general understanding. It's always a smart move to sit down and discuss the specific details of your own financial situation with a qualified tax professional.